Hey guys, welcome back to Revanchist Wealth. DeFi Chad here, and we're going to get into our second video. In the first video, we formulated a general model for chains and how to value them with some metrics around the game and the self-perpetuating game that we said blockchains were. And, I thought we'd take those metrics and put some real values to them from the top three assets in crypto right now that we kind of consider it all because of how our model works, and kind of relate this back to the use cases we theorized for those properties that come from the network or come from networks that are decentralized, and that's credible neutrality, trustlessness, and permissionless-ness for the use cases like stable coins and the other stuff that we talked about, like stateless money. Okay, so let's go through and review the metrics. You know, for I think just to refresh our memories, right? Uh, these were the corresponding metrics. The model was, these mechanisms producing these properties and applying to these use cases. So how do these use cases get affected by how good your chain scores on these metrics, right? So let's go through mission. Solana and Ethereum, they have a slightly wider mission, I would say, actually, than Bitcoin. Bitcoin was, invented for being a good money or good cash. And now that narrative has turned into it being like digital gold. But self-sovereign money is one use case, and we saw that once you have that, you can think of other adjacent immediate things like a financial system and other assets. And so Ethereum and Solana, Ethereum invented basically stuff outside of just trading the native asset back and forth by introducing, I would say, expressivity with their mission. And so their mission is not just a stateless money, but a neutral value layer for the world's asset. And one of our key theses is tokenization of all assets, and that driving the value of Ethereum and making our investment bigger. So I think that that's like a uh, wider use case than this one, which is this is like a subset of this. And I will say for Solana, it doesn't say the same thing because they stated, or like the uh, thought leaders and founders of Solana and people who build apps on Solana, they don't, as a way to, I guess, differentiate themselves from ETH. They're like, oh, like we don't care about moneyness, right? Ethereum's not money. Bitcoin's money. Ethereum's like a platform, and then we're a better platform. And so it doesn't matter whether our token has like money-like properties or like inflates a little bit more. Uh, its whole job is to just be part of this game, and we're going to make a better platform. So, and then part of that is how they say that is, oh, we have internet capital markets at the speed of light. Um, you'll see this if you go to like a lot of the, um, people who own Solana or like, the Solana circles, so to speak, and people who build on it and use it all the time, which I use it too, but I don't really like kind of get into the whole culture, quote unquote. And so they will say, okay, Solana's whole point is to be, decentralized, but have capital markets, at blazing fast speeds, faster than anything. And that's like the value proposition. Uh, I think this is a little bullshit because like blockchains are not the best at speed. That's not their point. Uh, yes, in economic activity, having a certain resolution of time is just like inherently more efficient because you have like less delays and stuff between things and less like stale information. And typically if you're trading something, you want to have the trade go through as quickly as possible and be reflected in the global state of the ledger as quickly as possible. So from that principle, like Solana culture is all geared towards like performance of their chain. And I'm not going to really shit talk this. I think like, I think it's the wrong approach. I think first, the much harder thing is like not being fast. It's, are you still permissionless and incredibly neutral, because there's costs to performance. But anyways, this is a trade-off that we'll talk about later. But in the mission category, I think Ethereum has the best mission. It's the widest, not as narrow as the BTC mission, but not as like contrived as Solana's mission. And I think it's like the right security first or Lindy first approach that should be taken. Dev Mindshare, I think, is a really stark contrast between Ethereum and the other two, which is, I mean, these are just from TokenTerminal, and I'll go through the TokenTerminal um, UI for some other things later in the video, but these are all just kind of rough estimates, right? And Dev Mindshare for Ethereum is like far and away much higher than even the more Lindy or bigger market cap asset, Bitcoin. And this is kind of obvious why, because these are things like that are still developing and are still like being worked on. Whereas like Bitcoin, and most people will tell you like, okay, it's like a finished product, a finished thing, and there's no changes, right? There's no large changes at least, and so you can build on top of Bitcoin, and that I don't think is like kind of reflected in this core dev mindshare, our core dev number as dev mindshare that I've put up here, but that it's still a very small amount of people. Um, okay, so this brings us to the third thing, which is like I think the most key metric in our model, which is the Lindy. Again, this is because it's the upper limit to how much money people will put on your chain. So you can see here, like if I did the very simple integral, the dumb integral as I call it, which is just, what's the market cap now? When did it first reach $1 billion? X days ago. Well, you just take like a big triangle or half of a square for like the area under the curve of TVL in time. And so, with that really simple approximation formula, right? Like Solana, the current market cap is 130 billion, 1,800 days since it reached $1 billion in market cap, divided by two. 117,000. And this is just a number, right? Like we can choose to like represent Lindy. And we can calculate this like we have for across chains to get like our domain or range where like this like unitless kind of value or like, nonsensical unit value can be like benchmarked against other things like for investment thesis. You can see here though that like Ethereum is like way higher Lindy than Solana because it's been around for a much longer time and it has much more TVL. And you can see that reflected in the TVL figures, right? There's only $30 billion of tokenized assets on Solana, and 10 times as much, an order of magnitude more on Ethereum. And the other thing that you can see that we said was like a measure of kind of alongside Lindy, right, is the global liquidity, which is like how many monkeys around the world value this asset. And you can see this kind of just follows that Lindy curve, right, of like, or that Lindy progression. But I want to like kind of for you to notice a few things. So from Solana and Ethereum, it's roughly kind of proportional, right? Like the Lindy for the two, and then the global liquidity for the two. It's like 5x here. So there's 50 billion a week in Solana swapping hands for some currency, and Ethereum it's like 250 billion. And for the Lindy, it's like kind of a similar, maybe a little bit more, a little higher of a ratio. But then you get to Ethereum to Bitcoin, and Ethereum has less, like 5x less around for Lindy here for Bitcoin, but it's only 100 billion a week short of the volume for Bitcoin. So this is one of the reasons, and I'll get to in the larger picture why, but this proportion, you can see that like Ethereum has is punching above its weight class in terms of global liquidity, right? There's a bunch of monkeys that value the thing, but the price doesn't have the monetary premium that you see Bitcoin commanding, right? Because you can see that it's like 2 trillion versus 500 billion, right? So a 4x, 5x increase. Same thing for the Lindy, but we're really close on liquidity or global liquidity. And then the other thing that I want to point out is in terms of the TVL and fees. So two things. One, in favor of Solana, or like allocating something to Solana, which is that its TVL is it's 10x less. But look at the fees. The fees is 8 million a week versus 12 million a week for Ethereum, right? So with 10x less capital, because Solana is a fast chain and it's scalable on the first layer, or it's like a there's more transactions from many people that can happen at a single time, right? Because of the bandwidth. Whereas on Ethereum, because it's still scaling, and it's scaling in a different way. The base layer has only 12 million on 10x the TVL, because it's like limited to 20 transactions per second on that first layer. So we'll also get into a difference in how all of these chains scale, but I think that you should allocate something to Solana, because even though it falls short on some of these other metrics, and like it's going to take time for it to raise its limit here, build global liquidity and trust, or like ubiquity around the globe, and build like how many people are playing the game versus Bitcoin or Ethereum. It's punching above its weight class because of one of its strengths, right? And like maybe it will be enough to compete with ETH one day, right? So that's why we allocate a bit there. The final thing on fees are TVL and fees. TVL is nil here for Bitcoin because there's no smart contracts on Bitcoin. So you can't someone can make their own asset on Bitcoin. So TVL 0, but of course Lindy is not 0 for Bitcoin because of the fully diluted value of Bitcoin itself, which is worked into Lindy, but I kept out of this TVL figure because that's more of like a direct user decision, right? Of like, I'm going to go issue this asset on this chain, which is relevant to our use case, or our investment thesis, which is like tokenization of all assets. Where do people choose to tokenize assets, or where do assets choose to tokenize themselves? That's a really important thing. Right now, it's 10 to 1 Ethereum to Solana. And fees, though, is the interesting thing, which is why we allocate a bit here. The final thing is the sanctions ship tests. And this is also, I think, where Ethereum really shines and kind of differentiates itself. I think because Solana, while it has these impressive things, right, like it hasn't proven itself to be truly decentralized. You can see the Gini coefficient is super concentrated for Solana versus like Ethereum or Bitcoin. And it was sold to VCs in the beginning, like I said in the first video. And I don't think it has passed the sanctions should test. For example, there's no Tornado Cash like app on Solana. And there is some privacy features on Solana, I'll give them that. But I don't think it has been really tested by a nation state. And while in this friendly regulatory environment, that's fine. You don't want to like have a chain that people aren't like kind of die hard about running and perpetuating, right? Because you're going to put your money on this thing. So Ethereum, and Bitcoin, it had adversity in like China banning Chinese Bitcoin miners, and there were many of them, many Chinese Bitcoin miners, and those Bitcoin miners simply like moved their capital and like kept doing it, or were subversively doing it in China. Russians used the Bitcoin chain during being sanctioned for their misdeeds across Europe and Ukraine and stuff. And it worked out for them. They didn't use it too much, but they could do it without anybody stopping them, right? And Ethereum, I think, is the most directly attacked chain in that FinCEN sanctioned Tornado Cash specifically and like made it criminalized it, and that meant that American validators of Ethereum were kind of held to this, and the network overall didn't care. Essentially, it kept processing the transactions, even though some validators did choose to listen to FinCEN. The network itself, as a whole, basically said, "Fuck you, Uncle Sam. I don't care. We're still going to process these transactions." And then it's not like um, the Tornado Cash app is like a flimsy thing or like useless or not important. North Korea used that Tornado Cash app to help fund its nuclear program by like routing cash through in an untraceable manner, and basically to say that the incentive for Uncle Sam to care about this was high, and it's not like they half-assed it. They were serious about this, and had a big incentive to be serious about it. Yet the network survived, and basically gave them the finger and kept working as designed. So that's good for us because we're betting on those properties of Ethereum being so ironclad that it supports the largest and most impactful use cases, and it incentivizes asset issuers to issue on the most credible, secure, and neutral platform. Okay. Okay, before we move on, I'll say one or a couple of things about things I haven't touched on for fees for Bitcoin, and this Gini coefficient. So for fees, this is highlighted in red because one thing that stops us from allocating as much to Bitcoin and makes us more comfortable allocating to Ethereum instead is this low amount of fees for Bitcoin, despite its much higher market cap and much higher global liquidity even. And this is because there's a dependency of miners who secure the chain on these fees being high for Bitcoin to be secure sustainably. So currently, if you've heard like the 21 million limit on Bitcoin, we're not at that limit. And every block, there is a block reward or new Bitcoin basically being created, still under that 21 million cap because we're not there yet in terms of circulating supply, but that gets issued to miners and that pays them for them playing the game, right? And that's how the network stays secure. But the subsidy is being cut in half, every X amount of time, right? So it halves every time period, like 4 years. And so this drove cycles in the past, but um, there's only been like a handful of happenings, and so far the Bitcoin security budget has been enough to incentivize miners to mine it. Um, but if it starts going down, then you can think of it as like a hard limit on the operational cost for security to the Bitcoin network. And what this means is uh, because there's less money going out to miners, the hash rate of the network starts going down. Hash rate has been monotonically up for Bitcoin so far, even through the halvings, but this might not be like like a linear process. It might be like the turkey that dies suddenly one day, right on Thanksgiving. But the fees were projected by Bitcoiners to cover this. The problem is when your use case is self-sovereign hard money and nothing else, um, nobody wants to spend hard money. Like nobody, if you think about gold and how often it like moves and changes hands, it doesn't actually. It stays put, or people hoard it. And that's true of actually any good money, any good hard currency, um, or asset. It gets hoarded as like a store of value, right? And so the network doesn't see, proportionally more and more people sending Bitcoin transaction and paying fees for it. So it's unlikely that these fees will support the same amount of budget for miners to run mining equipment and protect the network as the halvings continue and that subsidy disappears. So and this is like, there's a lot of argument around this. There's folks that say, okay, something will be figured out. There will be something that pays miners, or miners will altruistically mine, which is not great in terms of game theory and our, um, model of blockchain networks, where this incentive to play this game exists, and that's why people keep doing it. Um, but as soon as we get to a halvening that, maybe it's like below the mark and it's like profitable to attack, because think about like the market cap as well, or the incentive to attack. So the more Bitcoin is worth, the more incentive there is to attack or try and steal some of the value, double spend the value, or even if you're a competitor and want the market cap of Bitcoin, or like Ethereum, right? Like if there was some diehard Ethereum folks who wanted to attack the Bitcoin network just to kind of, get that number one spot finally, um, then it may be an issue. So that's one thing. And then this Gini thing, Gini coefficient, uses Lorenz curve to kind of give you a 0 to 1 index of how unequal or completely fairly distributed something is. 0 being completely fairly distributed, and 1 being like concentrated in the hands of one person. Well, everybody has nothing else, or has nothing basically. So you can see that it progressively gets better for these assets. And what else correlates with this? And I would like to point out Lindy, which is that market distribution thing we talked about, where there's brutal times in the market, across these cycles of people caring and not caring about crypto, or thinking that, it's going to go to the moon, or everything is over and crypto will never come back again. In those types of swings in sentiment, the native asset gets distributed more and more. And so the more cycles it goes through, like Bitcoin's gone through more cycles than Ethereum, which has gone through more cycles than Solana. And we can see that Gini coefficient kind of follow the proportion of time differences between these three chains. All right, so let's talk about why we allocate to ETH over Solana and Bitcoin. And there are a few high-level reasons and a few detailed ones that I'll go through. Let's just go through one really simple one. We want to marginally take more risk, get more reward, and we think that the marginal nature of the risk is acceptable for how much more reward we will get. But we don't want to jump off the deep end and take extreme risk. So we don't go with Solana and allocating most of our value there. We go to ETH because it's already ahead and has Lindy, just stronger in our model, as we saw in the metrics above. And for Bitcoin, it has issues. It's huge, has much more Lindy, but again, we think its use case is too narrow, and we won't get as much reward as we will with ETH, or even Sol, right? With a small amount we allocate there. All impact from our use case. So like let me go up to the use cases. So permissionless compute, unstoppable smart contracts, there's like ingredients to the cool use cases like DeFi, decentralized open finance, the world's finance layer, stable coins, all of the world's fiat currencies, tokenized and freely tradable back and forth, as a neutral open foreign exchange market, permissionless borrowing for anyone in the world to borrow against their ETH or any other asset, say like an NFT of a house or something. So permissionless borrowing and even permissionless launches of companies or equities or other types of assets. So we theorize that like there is a Lindy based upper limit. So for tokenization use cases, and if our theory came true that all of these assets are tokenized, and we look at the Lindy limits, right, we'll see that, okay, because Ethereum has much more Lindy, it can fit a lot of the other assets on it, and still have security for it and have a larger impact in terms of the real world use cases and adoption of those use cases for things that run on Ethereum. So because the size of the market uh, and the amount of assets to be tokenized, ETH is more ready to take advantage of that hit while the iron is hot, and can gain market share against competitors like Solana. So we want to, choose the best chain with the most liquidity, just like assets will choose the best chain with the most liquidity and the most Lindy to issue themselves on, right? Um, the third thing is, the other kind of choice we can make is, okay, sure, you like Ethereum and for the tokenization use case, but isn't the Bitcoin sovereign money use case such a large TAM, a large market, right? Like the market cap of gold. And why not allocate a lot of your money there? A lot of people do that in terms of seeing Bitcoin as the least risky. But I think in terms of the security budget issue that we talked about, and that's the fourth point, right? And that kind of works itself into this third point, which is that you don't get as much increase with Bitcoin. It's already big, right? Yes, it can go even more, but it also has a competitor. And most people write off Ethereum as not a competitor for the store of value use case because Bitcoin has so much more Lindy and a higher market cap rate. It's ahead. We have ground to cover to catch up to Bitcoin to be a store of value and the largest store of value in terms of market cap. But I think that Ethereum, when it tokenizes all the assets, has all the fiat currencies on it, and is an integral part of the world financial system, it will make more sense to hold Ethereum as like the gas token for paying the Ethereum network to do anything on it, and it's fairly important to do because all the world's assets are on it. So if you want to interact with those assets, you need Ethereum to hold ETH, the asset. And it can also be a stateless money, right? Having that central role in the world finance system is a great reason to be valued, as a store of value, something that everybody ubiquitously needs. It has huge global liquidity, and it even provides a paid for service with the fees and stuff for people interacting, issuing tokens by deploying new contracts, writing new code, um, you know, servicing their end customers who want to use Ethereum by proxy. All of those things make Ethereum a better store of value, in my opinion, because utility um, for the network is not the same thing as utility for the token. So you'll hear a lot of Bitcoiners repeat this kind of monetary theory that a good money has no other use than being good money. And that's like the perfect type of good money. And that even gold, because gold can be used for purposes that are not, pure money, which is like jewelry or plating on different things, or like for electrical connectivity, um, because there's industrial utilitarian uses for gold. It's not as great a money just for pure speculation or pure like subjective value to be put into it, um, by many people around the globe. But I think that that's actually a good thing to get it to be um, like something with a minimum floor of value. Um, I think that it's much easier to value something that's useful like that than something that is just kind of like a pet rock that gets traded back and forth. Anyways, oh, last thing that I forgot to put on here is Ethereum has native yield on it, as does Solana, but Solana has the riskier propositions and weaker metrics. So, we do Ethereum, and Bitcoin doesn't have a inherent yield. It's just, like I said, pet rock that you can look at. Okay, finally, why allocate to Solana at all? Right, so I kind of shit on Solana for a lot of the things in terms of its mission and how it's distributed, and how young it is in terms of not proving itself yet, and kind of taking the wrong approach to scaling that I mentioned before. However, I could be wrong. I could be totally wrong on that. And if we wanted to take marginally even more risk for more reward, and hedge our tokenization bet on ETH, then we allocate something to Sol. To give you an idea, I have like a 10-to-1 allocation for ETH to Sol. So if I have $1 million of ETH, I have like 100K of Sol. In the long run, if we look at the integral of TVL times time, which is our approximation for the concept of Lindy, that integral played out across time has the Lindy values kind of converge closer and closer, with these relative head starts between like Ethereum, Bitcoin, and Solana mattering less in a relative sense again, because it gets smaller, right? So once Bitcoin is like 30 years old, and Ethereum, which started like 6 years later, is only marginally younger, then the Lindy difference and the use case kind of difference between the two blurs. So that's good for Ethereum in that case, because it could be a more credible stateless money or a store of value. And for Solana, its role as a platform for permissionless finance, all those use cases like stable coins that we talked about, it has a better shot at a more impactful market share and role in that industry as well, right? So that's why we allocate a little bit of money to Sol or Solana, because we want to hedge. And if we turn out to be wrong about Ethereum for any reason, right? Like I said, I could be wrong. Then we kind of covered ourselves or covered our asses by betting on multiple horses. All right. I hope that helped you guys think a little bit more about the model and see how it applies with real numbers to real assets, and helped you reason through why we allocate, or why I allocate the way I do. So I recommend, currently the prices are going up, and we are in a bit of a dip with ETH. I think you should regularly buy small amounts of ETH, kind of just dollar cost average, or Sol, and if you choose to Bitcoin as well, and just kind of ride this wave through. You can track my DeFi portfolio and try and use some of the same things that I use, like Aave, to kind of leverage your position, or to LP actually, instead of maybe you want to just set a wide range for ETH trading, and just get like a steady 15% or something on your investment, and have it fluctuate with ETH. Not as much, because half is going to be dollars and half is going to be ETH. So hopefully you are allocating something, as we go through these transitions in price and adoption, with these treasury companies, everybody else kind of, finally getting the green light in terms of regulatory hurdles, and like the Wall Street, Wall Street firms kind of pushing it as well. I think it's the perfect time to allocate and kind of ride the wave up. Yeah. All right. Thanks, guys. See ya.